Hey everyone, we got some big news for Intel stock investors this morning as the Wall Street Journal reported that the company's close to entering into an $11 billion deal to increase manufacturing. Now, I'll go over the details of that arrangement, why the company might be considering this, what it could mean for Intel stock investors, and I'll do this in this short video here, so let's get right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the deal involves Intel and Apollo Global Management, which will supply Intel with more than $11 billion to help the chip giant build a plant in Ireland. Now, Intel's been working on expanding its manufacturing capacity ever since it started its third-party foundry business a couple of years ago. Arrangements like this allow Intel to expand manufacturing capacity and reduce the need for capital. Building one of these foundries are very expensive, and having a partner to help supply some of that capital alleviates some pressure for Intel because the company is not flush with cash. The company's balance sheet has been under strain lately as it's been generating losses on the bottom line, negative cash flow from operations as it's expanding, as it's building out this new business opportunity. And at the same time, the existing business, the core of the business, has not been incredibly lucrative. So these types of deals are necessary for Intel, and it wouldn't be necessary for some other companies like perhaps Apple, which has a abundance of cash and doesn't know what to do with it. So Intel's not in that kind of position. So these kinds of arrangements reduce the risk in some of these plans, which are risky to begin with. As I highlighted earlier, a cutting-edge chip factory can have a price tag of $20 billion, and its ability to pay for those facilities through its cash flows has been hampered by a slowdown in its core business supplying chips for personal computers. But Intel is not new to these kinds of arrangements. Roughly 2 years ago, it agreed to a similar $30 billion deal with Brookfield Asset Management. The deal called for Intel to fund 51% of the cost in Chandler, Arizona, and have a controlling stake in the vehicle that would own the new factories. So this isn't something Intel is doing for the first time. It's done this before. It liked the outcome of those previous arrangements, and it's continuing on this path. And from my perspective, I like this move from Intel. I like that it's diversifying its asset base in terms of providing the capital to build this manufacturing facility. Intel, remember, its stock price has been under pressure. Intel's trading at a forward price to earnings of 15.36, and it's lagged the semiconductor industry overall, especially in 2024, as the artificial intelligence frenzy has boosted several of these semiconductor stocks and the semiconductor industry. Intel has lagged behind because of those losses on the bottom line, because it was late to the game in developing this latest generation technology. And so it's being punished by investors for its decisions, its lack of investment in the newest technology. So now, new CEO Pat Gelsinger, well, I shouldn't say new, it's been a couple of years now, but the new CEO is trying to get things right. Is trying to make up for the lack of investment in previous years. And I could argue that it's being overdone here. All of this expansion, all of this spending all at once might be a little much. However, the timing is so good because countries are incentivizing businesses to expand manufacturing, especially chip manufacturing. They want to have diversified supply chains. Right now, a lot of this chip manufacturing is concentrated in Southeast Asia. And so worldwide, governments want to diversify that supply chain, and they're offering billions of dollars. Notably, the US government is offering Intel billions of dollars to help facilitate the building of these manufacturing facilities. So that's partly why there's such an eagerness from companies like Intel to go ahead and expand, and then coupled with the fact that demand for these semiconductor chips is soaring due to the rising effectiveness of artificial intelligence. Now, I highlighted Intel has not performed well the last few years as it's been building to catch up. The previous 5 years, earnings per share has decreased by 33% per year. Not a very good 5 year stretch for Intel. However, investors expect that the next 5 years, their earnings per share will grow at 39.84% per year for the next 5 years. So while the previous 5 years has not been great, investors expect things to turn around rapidly for Intel going forward. And if this turns out to be true, that could be a big benefit to investors, to be sure. Now, I've recommended Intel stock as a buy. I think the valuation is attractive considering the prospects going forward. I have highlighted, though, that Intel stock is risky because so much capital is required in this specific business category, in this specific business segment. The good thing is, though, that because of those large capital requirements, it makes it unlikely that new competition will enter the fray. It's going to be among the big players, right? Intel, Taiwan Semiconductor, Samsung. They're primarily going to generate the manufacturing of these chips. There may be some other players, but those are going to be the big ones. And it's difficult for anyone else to enter the industry. One reason I highlighted already because of the large capital requirements, and the other reason is because of the know-how. It's difficult to develop this expertise in semiconductor chip manufacturing, especially for the most advanced nodes. So big news here for Intel. It's, I think, a good decision. I think a prudent decision from management. Remember, this is not finalized yet. They're just saying that they're expected to enter into this deal. I think it's a prudent decision from management because so much capital needs to go out for these expansions that reducing some of the risk by partnering with third-party firms or other firms to help alleviate some of that cash crunch, I think is a smart move. I think going forward, Intel will likely make more of these deals because you've seen them do it before. You're seeing them do it again here. Now, it's going to be a treacherous path forward. Intel stock investors should expect a choppy road. It's going to be a while before these manufacturing facilities come up and start running and reach economies in scale to generate profits again for Intel. But when they do, those profits are expected to ramp quickly. So if, I should say, not when, those facilities generate profits, and if they go as planned, they could generate huge proceeds for Intel. But the big risk is if this happens. It's not for sure that these expansion plans will lead to increasing profitability for Intel. The expectations are that it will, but it's not a certainty. And in my opinion, I think there's a reasonably good likelihood it will lead to expanding profits, but it's not a sure thing. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.